No one is born knowing how to handle their own finances. It's a skill that we learn over time and as such often with mistakes and lessons learnt along the way. But there's no reason young people have to learn all their financial lessons the hard way. Considering the cost of a college education, many graduates end up moving back in with their parents or other relatives just a few months after graduation. This can be tough for everyone involved. If your teen has figured all of that out, they are on the right track to managing their money. These are the 10 essential finance tips or rules for young adults that can help you get started on the path to future financial success. Learn self-control. If you're lucky, your parents taught you the skill when you were a kid. If not, keep in mind that the sooner you learn the fine art of delaying gratification, the sooner you'll find it easy to keep your finances in order. Although you can effortlessly purchase an item on credit the minute you want it, it's better to wait until you've actually saved up the money. Do you really want to pay interest on a pair of jeans or a box of cereal? If you make a habit of putting all your purchases on credit cards, regardless of whether you can still pay your bill in full at the end of the month, you might still be paying for those items in 10 years. If you want to keep your credit cards for the convenience factor or the rewards they offer, make sure to always pay your balance in full when the bill arrives. And don't carry more cards than you can keep track of. This financial tip is crucial for creating a healthy future for your credit history. Protect your wealth. If you want to make sure your hard-earned money is protected, you'll need to take certain measures. While renting, a renter's insurance can protect the contents of your property in the event of a burglary or fire. Disability income insurance protects your greatest asset, the ability to earn an income by providing you with a steady income if you ever become unable to work for an extended period of time or due to illness or injury. A fee-only financial advisor will be more independent and can give you impartial advice in your best interest, while a commission-based advisor might turn you away from certain investments because they don't make him or her any money. This can happen without you ever knowing, so it's best to stick with someone who is professional and fee only. You'll also want to protect your money from taxes, which is easy to do with a retirement account, and inflation, which you can do by making sure that all of your money is earning interest through vehicles like high interest savings accounts, money market funds, CDs, stocks, bonds, and mutual funds. Know how to deal with debt. There are two kinds of debts. One can incur, necessary and unnecessary. With necessary debts, you're borrowing money to buy an asset that usually provides a long-term benefit. Take education for example. With the rising cost of tuition fees, it might not be possible for you to save and invest the entire amount you need. This could result in taking an education loan, which you will be responsible for paying off after you finish your degree. In this circumstance, it's hard to contest the long-term value of an education, which justifies you taking a loan. Conversely, buying a new mobile phone each year and having to pay high monthly installments or EMIs is just unnecessary. While easy EMI and pay later options have given us great convenience, that convenience tends to put most in unnecessary avoidable debt. In your 20s, your borrowing capacity tends to be limited, but it's important to ensure that you're not getting yourself into debt by buying stuff you don't need. Therefore, it's important to balance your debts while considering your long-term goals and budgets. Self-reflect on your expenses. It's easy to trigger happiness on shopping websites. Something is on sale, your debit card is already linked to your account, and voila! With a simple click of a button, you've ordered something straight to your doorstep. Yet, how many of us think how this seamless purchase fits into our larger budget? Do we consider how much we spend online versus how much we may be earning each month? When managing your own money, it's first important to be honest with yourself. If you're a newly working professional taking stock of your income, your expenses and potentially debts is a good starting point. College students and even teenagers can compare what their expenses are versus their allowance. This will give you an idea of your spending power, the potential savings you have, and more generally, the things you can and cannot afford to do with the money you make. Being honest with yourself is not limited to just mentally, physically writing these things down on a piece of paper to see where your money is going and coming from. Once you have reflected on your finances, you will have clarity on budgeting, which is the second step in this process. Start saving for retirement. Just as you headed off to kindergarten with your parents, hope to prepare you for success in a world that seemed eons away, you need to prepare for your retirement well in advance. Because of the way compound interest works, the sooner you start saving, the less principal you'll have to invest to end up with the amount you need to retire, and the sooner you'll be able to call working an option rather than a necessity. Company-sponsored retirement plans are a particularly great choice because you get to put in pre-tax dollars. Companies will often match part of your contribution, which is like free money, and the contribution limits tend to be high, much more than you can contribute to an individual retirement plan. Increase your savings. You're earning more, so you should be saving more. That means you should contribute more to your emergency fund. One way to increase your savings is to make it work harder for you. That means you should take action to earn interest on your savings. In your 20s, you might not have thought about investing or ways to grow your savings, so you parked your money in a traditional savings account, but there are better ways to make that money work for you. Parking your money in an online savings account, a money market account, or a high-yield checking account will help you accrue interest on your savings. Shop around for the best savings rates. Review your insurance coverages. In a lot of cases, people are being talked into buying life or disability insurance even if they may not need to. Perhaps it was a condition of getting car financing, or maybe someone told you whole life insurance is better than term life for investment purposes, for example. On the other hand, it's important that you have enough insurance to protect your dependents and your income in the case of death or disability. Beware of bad advice. Educate yourself. If you don't take responsibility for your finances, then others will find ways to waste your hard-earned money. Some people with bad intentions may want to use these systems, like financial planners who try to convince you to invest in schemes that are too risky. Others may be well-meaning but not fully informed about your circumstances, like relatives who make blanket recommendations about the importance of owning your own house, even though the only way you could afford to buy right now would be taking a risky adjustable rate mortgage. Instead of relying on random advice from unqualified people, take charge of your own financial future and read a few basic books on personal finance. Once you're armed with knowledge, don't let anyone get you off track, whether it's a significant other who siphons off your bank account or friends who want you to go out and blow tons of money with them every weekend. Have a savings plan. You've heard it before, pay yourself first. If you wait until you've met all your other financial obligations before seeing what's left over from your savings, chances are you'll never have a healthy account or investments. Resolve to set aside a minimum of 5% of your salary for savings before you start paying your bills. Better yet, have money automatically deducted from your paycheck and deposited into a separate account. Guard your health. If meeting monthly health insurance premiums seems impossible, what will you do if you have to go to the emergency room, where a single visit for a minor injury like a broken bone can cost thousands of dollars? If you're uninsured, don't wait another day to apply for health insurance. It's easier than you think to wind up in a car accident or trip down the stairs. You can save money by getting quotes from different insurance providers to find the lowest rates. Also, by taking daily steps now to keep yourself healthy, like eating fruits and vegetables, maintaining a healthy weight, exercising, not smoking or consuming alcohol in excess, and even driving defensively, you will thank yourself down the road when you aren't paying exorbitant medical bills. Remember, you don't need any expensive degrees or a special background to become great at budgeting. If you follow these 10 financial guidelines, you can be as financially prosperous as someone who has a hard-won understanding of finance. If this information is helpful for you, then just give this video a thumbs up, subscribe to the channel, and press the bell icon for more informative videos like this. Goodbye.